Well, it's time to define a marketing term. Commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub, joins us. She believes, of course, the key to profitable grain trading is building knowledge about the fundamental practices of the industry. Today, we'll discuss just exactly what makes a futures exchange. What is it that makes up an exchange?
It doesn't really have to be anything more than a couple of people standing around and exchanging contracts. In history, in London, in Chicago, hundreds of years ago, they started doing this literally, people standing in a physical location, and they would exchange basically pieces of paper, just legal contracts committing them to buy or to sell a physical asset, commodity in this case, at a certain point in the future. So that's all it takes to be a futures exchange. But now today, it's a much more regulated situation. You've got the CFTC making sure that these futures contracts are standard, that people are not manipulating the markets. But really, and furthermore, they're not necessarily a physical place anymore. Now you've got people participating. Now the actual exchange is really a computer server somewhere, the CBOT. All of these entries, all of the order entries are coming in electronically, not all of them, but a large proportion of them. So that's what it takes. It just takes a facility to take in buy orders and sell orders for a time and the price in the future.
Am I correct that a securities exchange and a futures exchange are actually two different items regulated by two different governmental entities, meaning the securities exchange is regulated by the SEC and the commodity futures exchanges are regulated by the CFTC, but they can operate kind of simultaneously. For instance, the CME Group does both.
Yes, that is correct. And the reason that the CME group does both is because they're doing options on stock equities. So the options market has really grown up out of the commodity futures world, but now that there are options on stock indexes and individual single stock options, that sort of is the crossing point between those two worlds, like you say. And also because a lot of the same people, or a lot of the large money, the big investors are participating in both markets. And when you talk about the systemic risk of any one of those too big to fail entities failing and taking down all of their positions at the same time, now the regulators certainly are looking at making sure that their regulations between the SEC and the CFTC sort of cooperate more. But that's an evolving thing to watch for.
Now that we've made that transition to the CME Group and that it covers both securities and futures and is regulated on by two governmental entities in this case, let's go a little deeper into it on the futures side, where we have both pit trade and electronic contracts. What's the difference between the two?
Really nothing. In the assets being traded, nothing. They are both interchangeable. You could put in an order to buy a corn futures contract with your broker to go through the floor and have an actual floor trader execute that buy order, and then 5 minutes later sell it electronically. They are interchangeable. And two of the U.S. futures exchanges, the Minneapolis Grain Exchange and the Intercontinental Exchange, which is huge in Atlanta. It's, in the process of buying a New York Securities Exchange. So they are both exclusively electronic. They do not have a floor where physical people are shouting at each other and exchanging futures. So Chicago and Kansas City still do, but in time will tell how long that lasts.
Is there much of a difference between whether an order goes in electronically or through open outcry? And open outcry, of course, has a limited set of hours that it's open.
There's that for a difference, and there is a difference in the speed. You would probably get a faster fill electronically. There are some things that really you're only going to want to do with the outcry floor, and that's if it's just plain vanilla buying and selling of futures or options, that it really doesn't matter. But if you're perhaps executing a large spread order, if you're a commercial entity, or you have good till cancel orders with specific time frames, things like that, really specific instructions that you want someone to understand, a lot of times the brokerage may only allow you to do that through a floor broker rather than electronically.
And options, if my understanding is correct, are so plentiful that they haven't been able to come up with the correct algorithms, the exchange spreadsheets, or something along those lines to be able to manage all of them. And so it's quite likely that that will continue to be open outcry, even if the pit trade for a futures contract might go away eventually.
Yes, there does seem to be a lot more resistance to getting rid of the floor options traders.
Okay, now let's talk about high frequency or algorithmic traders, black box traders you have mentioned in the past.
Yeah, I mean, they're sort of controversial, and maybe they shouldn't be, because really a trade is a trade. If you develop some trading system, let's say every time the corn market drops 5 cents, you want to buy a corn futures contract. Now you just program that into a computer program that does that, and it's still executing your program that you developed. The danger that comes into it, a couple years ago, the stock market had that flash crash where all of the algorithmic traders, there was really no human in there selling, but all of the selling sort of became a self-fulfilling prophecy, and everything just fell at the same time because the computers were doing it. That becomes the danger of the high frequency or algorithmic trading. But philosophically, a buy order is a buy order, a sell order is a sell order, whoever is willing to do it, and however they're willing to get that into the market.
And finally, can you look into the crystal ball and tell me what you think the futures might look like in 5, 10, 15, 20 years?
Well, I don't think that, like I said, philosophically or practically, that there's any way that you could regulate out high frequency trading or algorithmic trading. I think that's here to stay. So if anything, that's probably going to get larger in the next 5 to 10 years, let's say. And I really don't expect to see the Kansas City floor traders around forever. And someday I don't expect to see Chicago floor traders around.
Thank you so much, Elaine.
Thanks, Todd.
That's commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub. For University of Illinois Extension, I'm Todd Gleason.